would like to thank the organizers of this conference for inviting me to make a presentation. As I work through this, I'll say all protocols observed as well this afternoon. So when they first asked me to speak today, I thought to myself, boy, my life has come full circle, because I'm a daughter of a founding member of the Bombay Stock Exchange and the granddaughter of the founding member of the Chennai Stock Exchange. And both my grandfather and my father were chasing me to join the firm, and I kept saying, no, I need to go see the world, and I don't want to be part of it. All of a sudden, I feel like 20 years later, this invitation came, has kind of brought me back into the fold. And maybe a little bit, today I just want to cover this issue about boosting liquidity. A little bit about my background, because it's a bit of a combination of public sector experience with private sector experience. My first arrival on the continent was 1989. I'm older than I look, probably. And basically, I was asked to help the government of Sierra Leone on privatization of state-owned assets. It was agricultural assets. And what really struck me was, as we're today talking about capital markets, there have been previous attempts at capital markets. I remember J.P. Morgan being in Accra, trying to fund post-1970s oil money that was coming into it, that put a lot of countries into debt. So there's a correlation between capital flows across the continent over the last 30, 40 years. For example, there was capital flows in the post-colonial period. There were capital flows in the post-1970s oil crisis onto the continent. There were capital flows during the post-Cold War. And now we're in the post-Civil War transitions, the first, second, third generation capital flows. So I really would like us to think that there are many attempts that have been over the last 40 years about trying to attract money into various economies under various structures and various regimes and policies that have happened. The second thing is basically between the 90s and 2000, we spent a lot of time in ungoverned spaces on the continent. I always say to people that either you have governance frameworks that manage your natural resources, or ungoverned spaces that are being, where capital and the natural resources are not being, there's no value added to it. So just second, if you go to the next slide. Oh, sorry about that. Okay, next. So I want to talk about demographics because in because public sector issues are, for me, the public sector is key to driving almost everything, because in a continent that is this young, the public sector cannot let go of its role in protecting the interests of the population. And I hear all the time, right now I'm working on a deal in East Africa, and people say, what are you doing? Why isn't the government doing this? And I said, well, if 70% of your population is under the age of 18, then you have a different type of regulatory frameworks, different type of capital demand, and different type of institutions, where the weight of delivering goods and services lies on the public sector, and trying to not crowd out the private sector is a huge, huge burden on any political leadership or ministerial efforts on this. And national development plans really drive a lot of our investments as Yatra. So our philosophy basically is, what's the national development plan? Which sectors of those national development plans are naturally regulated by the government due to the way they deliver those services, and what sectors really can go to the capital markets, and how those flows bring in money into the country, which then improves the ability to regulate, because without gas, no car runs. And so for me, we can have as many great reforms on paper as possible, but if you don't have it run through things, then it's an issue. I want to talk about something that hasn't been raised today, and I think it's really fundamental, crucial to how all of you, each country, each region, will pursue these capital markets and financial development, financial services. You just signed the Africa Continental Free Trade Act, and it is probably one of the, we're now going through it country by country through the entire act and trying to find where there's a synergy across regions. You just heard from the Botswana Trade and Investment Organization. I mean, they're thinking regionally, and I think that's where this story will take place. The ability to advance financial services, develop financial products, and really think about cross-border regulation. Right now we're on a cross-border investment, and we're having to deal with multiple markets, both in all the countries that we're dealing with that we want to invest in. And the reason that I say this is the demand for financial services is only triggered by incomes. And right now, only 1 in 5 Africans work in a wage economy. And that means if you don't have that domestic income base, it truly tells investors like me and others, my counterparts, that where is the driver of savings? What are the things that, where's the human capital? Where's the demand for goods and services? So there's a huge story that needs to be told, not only as individual stock exchanges, but as a regional entity too. And for example, the biggest issue on financial services that we're dealing with across at least we're looking at in the East Africa region. I'll just give you one example, and I'll just shift it over. Every country in East Africa imports fuel. And that will tell you where their money is going in a public sector budget. So it is one of the largest expenditures in a public sector budget. So 3 things that I would say at this point is basically when you're looking at your capital markets development and financial services, you have to look at the public sector expenditures, because that will tell you where the priorities are in terms of keeping stability, maintaining inflation, controlling inflation, and things in that regard. The other issue is job creation. We find there's a huge correlation between job creation and the demand for financial services and products. Because we, in one of our projects, we employed about, I think, 20 or 30 people, and immediately people who never held bank accounts wanted to hold bank accounts. So now we're looking at this as something we should, in addition to investing in projects and into instruments, we also are trying to see what's the correlation between the demand for the financial services. So whether we invest in transportation or energy or housing, there's a big, we are trying to look at what is driving the demand for financial services, particular to those sectors. So the other thing that I'd like to add is when we sit down with governments, we usually ask them, whether it's a trade and promotion agency or line ministries, we think that risk management starts with the public sector participation in the financial services and managing how we do this. So for us, basically we have, in our research team, we looked at target countries that have GDP targets to become middle income. We looked at countries that are significant economic reforms, not in the broader sense, but basically in specific industries. And last is countries that are going through transition, whether it's economic transition or security or political transition. And we try to look at these 5 sectors as being the underpinning of an economic growth, GDP. Because without GDP, there is no demand for capital at this point, because a lot of it is about 5 years ago, or maybe 7 years ago, it was 50% of national budgets were externally financed by development assistance. So for me, this story of where do you want to add value, I'll ask our panel this afternoon, but every single person, we are partners with the Milken Institute, and we take on fellows from African governments who come into our private sector deals, and they work on them. And one of the things I ask them is, how many of you have sat with your line ministries? How many of you have sat with your savings? There are lots of savings groups in countries, and really understand where the money is flowing in the country. And it's a real disconnect between wanting the structural investments done, but not underpinning it with GDP, savings, incomes, wages. And that's the story I think I would ask all of you to consider as you pursue your thing. The second thing is enabling environment. No amount of, if there is no increase in GDP, really it's a really difficult story to tell about a country. Right now, I think we're looking at, it takes the current numbers of $1,000 on the continent as a whole. If that continued between 1% to 3%, let's say, and if you're one of the other targeting middle-income countries, you're looking at 5% to 6%. Then you're dealing with the issue of you need almost 30 years to get your GDP rates up in that regard. So that's a huge issue. Industrial development, I think as our colleague formerly mentioned, there is significant populations still are in agriculture, and so a big part of our effort is to say what sectors in each of these countries will kick them up into middle income or accelerate the prosperity aspirations that they have. And that's a key investment corridor for us. So we picked a couple of countries, and we picked housing in one country, we picked transportation as a hub, and then we picked energy as another. So it's a real, for me, overall, a lot of the liquidity demand boosting into the market really has to go in line with several of these enabling environment bits that I think all of you are aware of. The other bit of this is urbanization, about where future labor will come from and where future consumption will come from. There's a big assumption that the financial services there's a demand for it, and it's equally attributed along both rural, urban. 5 of the largest cities in the world over the next 10 to 15 years will be on the continent. So a big question for you as you develop financial products and as we develop financial product is, where is the consumption of these products? What is driving it? Where's the labor pools? Where's the shifting of these labor pools going to take place? And this is, I would say, of all of them, that is one of the biggest stories that is not fully explored or delved into, the impact of large urbanization on all of the services, not only social services, but financial services, and how does that work? And technology may be one solution, but I'm of the view that underpinning, you can't have instruments drive interventions. You actually need interventions that determine what type of instruments you're going to develop in many instances. The trend that's happening is, as you know, with U.S. trade in China, Brexit, TIPP in Asia, there's lots of trade agreements being signed, and the question for all of us is, where does the continent fit into all of the ongoing global trade agreements? And how does the Continental Free Trade Act impact the other trade agreements that are being signed bilaterally or by region? That tells you where you have the ability to participate in an economy at this stage. I mean, we can pick sectors, but those trade flows will really determine many of the competition, where the competition for capital is. And then lastly, people say corruption, corruption, corruption. I say institutions, 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 because that will reduce unpredictability, uncertainty, and really de-risk. I always tell people in any relationship, you first have to recognize the value, then you have to get over your fear, and then you probably are shifting to greed or wanting more. And that pattern we kind of look at in countries on the continent where people say, oh yeah, I recognize Ethiopia or Uganda or Botswana. And then we go back to them, they're like, they know a little bit more, and now they're afraid. So I actually think when you're afraid, it's good because you've been recognized, and there's a need to want to understand and de-risk that piece of it. So it's a real human behavior that we deal with. There was another one. Okay, so basically, for me, there needs to be a critical mass. And I think these are the 5 sort of fundamental questions about achieving critical mass. When you look at all the companies that are listed on the stock exchanges that you have, and companies that are not listed, and as you heard from the panel this morning, it's a huge range going from why you want to be listed, why you don't want to be listed. One of our goals is we're setting up a company, a company in Africa, bringing in foreign capital, trying to partner with either the government or SMEs on the continent, and try to take them public by lending international FDI confidence to those companies. So one of those companies we hope, will list on many of your exchanges, which is one of the things that we're trying to explore. But quality, size, ownership of publicly listed companies is something that we're looking at, and trying to find the right scale is a key note. We're an infrastructure company, so we're looking at projects within $1 billion, investments between $1 billion and $3 billion. And so that's just the nature of the game of being in the infrastructure space. That's just how the scale of investments that's required. Now, if you wanted to take one of those infrastructure companies public, we're kind of looking at what stock exchanges are actually capable of doing that. Instead of listing it somewhere else, if you wanted to list one of those infrastructure companies. The second thing is financial products. Every day I'm asked, what if Citibank comes in, or what if these other credit cards come in? And I always say to them, the environment, the introduction of products is like introducing vaccines in many ways. You just have to know what you're trying to actually address. And a lot of times, I always say innovation may not be something you want to replicate everywhere. And that's a real struggle for everybody who innovates, including us, when we're like, hey, this can work here, or this can work anywhere else. The other thing is FDI and domestic investor base. That's something we find challenging. Try to understand the correlation between FDI and the links between how to improve the domestic investor base. And domestic investor base right now, the continent, are pension funds, those type of institutions that we're trying to partner with at the moment. Then the other bit is efficiency of listing, trading, and retail participation. We find that to be something that also requires a little further study because we reviewed a lot of the companies that have been listed, and in our survey, when we look at some of them, they tell us, listen, we're listed, but nobody's willing to buy our shares. But it goes to our colleague from our previous panel, the fear of control is a big issue on that. The last one, I think, is what I want to focus on because that's where we want to be and support, invest in financial intermediaries. There's not sufficient scale of financial intermediaries on the continent, and we're looking to see where we can help support the development of that. This is the last one I want to cover, and I will stop that. I mean, my goal today was just to simply state that when we're looking at an investment, these are all the things that we're looking at in a country. And we try to, so for example, we sat with the government and we said to them, which parts of your national development goals can be funded through the public sector, revenue, budgets, DFIs, development assistance, and which sectors can we take you and jointly have a joint equity partnership to develop commercially viable enterprises. So right now we're in the middle of developing a commercially viable enterprise in the energy sector. And basically we had to sit down with the government and talk them through about this. Some of it is state-owned enterprises, some of it is a joint venture where it's fully commercial, looking at investor risk return profiles. And I would like to say today that a big part of this discussion rests with three agencies in a government. Ministry of Finance. I say this because most ministries of finance on the continent are developed to go to the Paris Club, not to have the capacity to go to the Paris Club, but don't go to the London Club. Meaning that in any of your ministries of finance, there's a great amount of talent to borrow. And trying to structure investments and deals with the private sector, that capacity is something I think many institutions today are talking about really need to work. And so for me, boosting liquidity is threefold. One, where do you belong in the international policies? For example, there's a decision taken at Gleneagles, 0.05% of developed countries would send money into the emerging markets. Two, climate change. People are turning off taps of money saying we're going green or we want to go green. But I always say you're already green on the continent. Actually, we need to get you off the green and onto LPG and other fuels in that regard. And then the third piece of this is a real concerted effort that I find is a struggle, and I think it's in any continent that's gone through this, is the ability not to duplicate instruments from Western economies. When I go through CMAs in various countries or go through stock exchanges, it's not really a design specified for that country in some ways. So we always say, how can we adjust to the situation on the ground? So I call it both a myth of uniqueness, but also let's not deal with it. So for me, these things really have a huge issue on many of the, am I running over? I'll stop. Thank you. I just want to be sure. And so for me, I would say that top 10 things that I would like for us to kind of look at is foreign direct investment, because it allows for competition and for those investors to acquire shares in local companies. So we, at some point, would like to look at owning shares in local companies and what's that process going. The other thing is banking. GDP, as I mentioned, that's what determines demand for financial services. Savings, right now it's a huge issue on the continent for where do you put your savings in that regard. The other is inflation pressures. It's always downward if you have to switch from services to replacing, looking at money balances as opposed to transitions. Open on the foreign exchange. as you know, that's still a driving point for our ability to own shares in a company. And then liquidity is access. How easy is it for your population, if they save, to access their savings quickly? Because that's the thing that gives people confidence in markets. If I'm in a 401k, I have a health issue, I'm able to cash it and work from it. So the ability to respond to that type of human need is a big driver. And I'll end with a little bit of story on this. We're now working with 3 governments who have all carry a debt burden, and we are trying to take their value chains and seeing how much of that value chain can we take to the market. So we're looking at one around 2 billion, and one at 4, and one around 900 million. And basically, not that we're replacing public sector, they're financing what they can, but we're saying these are commercially viable and we can shift you to that. And this is, for me, I'm so happy to be here for 2 reasons. I've spent most of my career on the continent during the war years, the diamonds, trying to negotiate the diamonds back from the RUF in Sierra Leone, the rubber plantations in Liberia. It's been trying to get natural resources under control. So anything value add is something we're looking at. And I'll stop there if there's any questions, or I don't know how you cover this.
Thank you so much.
I want to thank you all, and thank you for giving me the opportunity to speak to this